The reason we have inflation in the United States, or for that matter anywhere in the world, is because these pieces of paper and the accompanying book entry, or their counterparts in other nations, are growing more rapidly than the quantity of goods and services produced. The truth is, inflation is made in one place and one place only, here in Washington. This is the only place where there are presses like this that turn out these pieces of paper we call money. This is a place where the power resides to determine how rapidly the amount of money shall increase. What happened to all that noise? That's what would happen to inflation if we stopped letting the amount of money grow so rapidly.
All right, today is Wednesday, May 12th. This is a recap for the stock market activities today. And what a day it was. It was a classic panic selling day, meaning even the good names, quote unquote good names, meaning the inflationary stocks, were also sold off. It was a throw the baby out with the bathwater kind of day. And there is nowhere to hide. Not in the NASDAQ, not in financials, not even in energy, because energy stocks were outperforming earlier in the day. By the end of the day, they also started reversing to the downside. Not even gold managed to hold today. Commodities, the majority of them in the downside. Even tulips in the crypto market, which the crypto maniacs tout as inflation hedges, they were also down today, meaning there was nowhere to hide today. What do we make of the action today? Usually when you see panic selling days, they last for a few days. There is a destination, there is a target for the correction to reach. We will try to find that out during the technical analysis. But the point to illustrate here is the following. Once the dust is settled, we will comb through the rubble and find out areas of the market to buy the dip. But you gotta be careful because the macroeconomics environment has not changed. The macroeconomics environment and every indicator is pointing for higher inflation, meaning that the likelihood is we will see some oversold bounces in the NASDAQ and the mania names, the high multiple stocks. Don't be seduced by these bounces because they're not gonna last. However, once the dust is settled, you will see dip buying in the inflationary names, in financials, industrials, energy, materials, stocks that are proxies for commodities, the likes of Freeport-McMoran, for example. Those stocks, you will see some dip buying because we've been waiting and waiting and waiting for dips in these names. The inflationary names, the Biden names that I showed you before, not all of them, but the ones related to higher inflation. These names will be worthy of buying the dip. And of course, you and I have been waiting and waiting and waiting to buy the dip in these names. Of course, now that these names are starting to sell off along with the rest of the market, we are starting to see fear and panic. And everybody's going to forget about buying the dip in these names. But market participants, specifically institutional managers, will see the dip in these names as a buying opportunity. You're not going to jump in right away and buy the dip right now. You got to let the process work its way. There is a broad correction in the market going on right now, and this is triggered by anticipation of tapering. We discussed this scenario a few videos ago, that the gap of performance between the SPY and the NASDAQ, the divergence will be closed down. The SPY and the inflationary names will also join the sell-off once we hit the taper tantrum. And what triggered the taper tantrum, by the way? It wasn't the jobs report last week, it was the CPI report this morning. The CPI report came way hotter than expected, showing the biggest surge of inflation since 1982, blowing expectations from economists. And by the way, this number is the cooked number, and it's already striking fears in the market. Can you imagine what will happen to the market if the real number was to be released? And of course, the Federal Reserve continues to deny, distort, and deceive by saying that yes, we're seeing inflation and it's kind of getting out of hand, but rest assured, it is transitory, without offering any guarantees or any assurances that inflation is indeed transitory. And by the way, what does transitory even mean? Because every inflation, if you look at it, was transitory. The great inflation in the 1970s lasted about a decade, but it was transitory in the grand scheme of things. It only lasted for 1 decade, not 2, not 3, not 4. So it was transitory. The Weimar inflation also was transitory. It lasted for a little while. So saying that inflation is transitory does not give market participants any assurances, any guarantees to continue investing in the stock market. And so long as the Fed continues to be vague and avoiding acknowledging the truth that the current policy is misguided and not needed, the current policy will only produce inflation, but it will not necessarily recover jobs or create new ones. And that is evident from the two most important macroeconomics data were received in the last few weeks. Number one, the jobs report, which was disappointing. Meanwhile, the other important macroeconomics data that we got this morning, the CPI, showing that inflation is rising rapidly. Grab your macroeconomics book 101 when you have higher inflation, but the employment market is not recovering. This is a recipe for stagflation. These mad scientists over at the Federal Reserve are playing with fire. They have no clue what they're doing. What is the purpose? What is the end goal here of triggering higher inflation? What is the point if it is not recovering jobs? And of course, Chairman Jerome Powell, the mad scientist that he is, when asked what is the exit plan, what is the exit strategy for the Federal Reserve, he says, oh, let's not talk about the exit strategy because the markets are listening. The man is an unelected fool, obsessed with the stock market. He is delusional and out of touch with reality. And by the way, this is a clear illustration that while the Federal Reserve say that their public mandate are employment and inflation, that is all bullshit because their real mandate is to prop up, protect, preserve, and inflate the assets of the wealthy, stocks, and real estate. That is the Federal Reserve's real mandate. And all of this stumbling by the Federal Reserve is changing market sentiment. Market participants for a long time placed their faith on the Federal Reserve. This is changing now, and I see it from my own practice. Investors are saying, I am not sure that this inflation is transitory, and I have no faith in the Federal Reserve because it seems that they're out of touch and they are starting to lose control over the market. And this whole thing about the tools, oh, inflation is transitory, and if it's not transitory, we got the tools, bro. Well, what are the tools, by the way? The tools are tapering and raising interest rates, which means ending the party in the stock market. In addition to the lack of faith in the Fed, investors are starting to wake up to other threats to this market. For example, the risk of increasing capital gains taxes and corporate taxes. We also have the tax deadline coming up next week. What I'm hearing from investors is the following. Perhaps that the best days for the stock market are behind us. We've made a lot of profits, and now our faith in the Fed is disappearing. Furthermore, we have a lot of threats from taxations, and you are starting to see and hear this frustrated tone from investors, at least from my own practice, saying, sell everything. I don't want to hold anything right now. I have no faith in the Federal Reserve, and I have no faith in the federal government. Get me out of the market. This is the sentiment right now. Panic, sell everything, get me the hell out of the market, meaning that the pain will intensify and we will see more declines to come. At some point, things will settle down and you will see certain stocks bouncing higher once again and recovering. And the sentiment will change back to positive, and you will see those same investors saying, will get me back in the market, but in the right names. And yes, that will lead in a recovery in certain names in the stock market, but all in all, the better days of the stock market are behind us. You're not going to see the same mania that was going on in 2020 repeating itself again. You're not going to see stocks blasting higher 5% every single day. That's not going to happen, meaning that the market will become boring, a stock picker kind of market, and that will flush out the retail participation, not all of it, but the majority of retail participation. We will talk about that and a lot more, specifically during the headlines of the day video, which I intend to release later this evening. But for now, in this video, I want to concentrate on the market's data and technicals. So let's start by reviewing the market's performance today. And here we go. The Dow Industrial Average closing in the red, down big, 681.5 points, or a decline of about 2%. The Nasdaq leading the declines today with about 357.74 points to the downside, or a decline of 2.67%. The S&P 500 also closing down by 89.6 points, or a decline of 2.14%. What about the sector's performance today? Every single sector of the market managed to close in the red. Therefore, we're not going to give any medals today. The performance is pathetic across the board. Yet the declines led by technology, consumer cyclicals, and materials. Again, you see tech down, but materials also down, leading the declines. That tells you this is a panic day, throwing everything out, selling the good, the bad, and the ugly. Then we will sort through them after the dust is settled. What about the advanced decline ratio for the New York Stock Exchange? 13% advancing versus 85% declining. A decisive down day for the NYSE. What about the NASDAQ? 20% advancing versus 77% declining. Once again, a decisive down day for the NASDAQ. Moving on to futures, what's going on here? There is a lot of confusion because it is a confusing day. It is a panic selling day. The question is, if inflation is rising higher, then shouldn't commodities have outperformed today? You gotta bear in mind that in a day like this, the dollar index is spiking higher. When the dollar index spikes higher, commodities suffer across the board. But you also got to keep in mind that this was a panic selling day, and that is evident by the performance of commodities today. And by the way, here is the other question. Why did the dollar index rise today? Once again, when we have panic selling, lots of liquidating of assets across different markets, investors are liquidating these assets in exchange of US dollars. They're raising cash, therefore pushing the US dollar index higher. Yet we saw modest gains for crude oil prices, up about 1% or so for both the WTI and crude oil Brent. What about softs? The gains are led by coca and cotton futures. Coca futures outperforming today. Yet we saw sizable declines led by lumber, coffee, OJ, and sugar futures. What about metals? Declines across the board. The US dollar is higher. In addition, yields exploding higher once again. Gold, silver, they don't like the rise in yields. They can tolerate a rise in the US dollar, but a rise in yields slams gold and silver. They tout gold as a hedge against inflation. That is not proven. The only time in recent history, when we saw gold working as an excellent hedge against inflation, that was back in the 1970s when we just got out of the gold standard. But since then, specifically during the quantitative easing era, the correlation between gold and treasury yields is actually inverse, meaning that when inflation rises higher, pushing yields higher, that in turn pushes gold prices downward. The other commodity, copper, is more sensitive to the movement in the US dollar, not yields. Copper and yields actually have direct correlation. Copper is more sensitive from an inverse relationship with the US dollar, meaning that when the US dollar rises higher, copper suffers. Likewise, we saw declines for platinum and palladium futures. What about meats? The gains are led by feeder cattle futures. We also saw gains for lean hogs futures. Meanwhile, live cattle futures remained muted. What about grains? We saw declines for canola, oats, and wheat futures. And by the way, canola was down about 4%, not 9.5%. This is a mistake. They're not updating their contracts. But regardless, we saw declines in canola, oats, wheat, and corn futures. Yet we saw sizable gains for soybean oil, soybean meal, and soybeans futures. Now, here's the other question. Will commodity prices recover from the declines we saw today? That depends on the market's interpretation of the Fed's reaction. If the market decides to call the bluff from the Federal Reserve, meaning that the market will expect tapering sooner than expected, then the correction in commodities will continue. But if the market interprets the Federal Reserve's action, or rather lack thereof, as a green light signal for inflation to continue to rise higher, because the Fed says, oh, this report is hot, but it is due to quote-unquote base effects. Okay, meaning that you're going to let inflation rise significantly higher, and you get another report and another report before the Fed finally decides to taper. And if that is the case, if that is the interpretation the market will choose, then commodity prices will recover and bounce higher once again. Moving on to the big casino, the options market, what's going on here? Let's start by addressing the absence of retail traders. In the first couple of months of this year, retail investors were still in the game, gambling and buying call options all over the place, hoping to create gamma squeezes. It is the same playbook that worked for them last year. But as we started to head into April and May, and the correction in the mania names, the retail favorite names started to intensify, all of a sudden the call options volume dropped off the sky. And this is extremely important because one of the reasons behind the market blasting higher and higher every day was the support of retail traders buying call options and creating all of these gamma squeezes. This is yet another layer of support that is being peeled off from underneath the market. And here is the illustration from today's activities. Even though we saw a massive down day, which according to the Robinhoodians and the likes, stocks only go up and there are no red days. And if there are red days, then there are opportunity to buy. This was the playbook in 2020. But now the disappearance of retail traders is becoming increasingly evident. Even in a down day, a panic selling day, they're not jumping in and buying call options, meaning the retail traders already got slaughtered. And here it is. You see it from the options volume. Apple at number 1 with a little over 1 million contracts. About 64% of those were calls. Tesla at number 2 with a little over 469,000 contracts traded today. And about 45% of those were calls. So this time around, options traders are buying more puts than calls for Tesla. And the volume is extremely low. Retail traders are not here to save Tesla. What about PLTR, Palantir? The name was up big yesterday in the YouTube community, the geniuses that they are. They've been pushing the stock on retail traders over and over and over again. Buy the dip, bro. Yesterday, they were validated because Palantir was up about 9%. But I told you, be careful of buying the dip in Palantir because the CEO is betting against you. Furthermore, it is a classic name of the overvaluation problem in the stock market. And if yields continue to rise higher, then names like Palantir, which are valued based on future earnings, what happens when yields rise higher? Interest rates in general rising higher. The current value of future earnings gets diluted. However, the future value of current earnings appreciates, meaning that when yields start to rise higher, you have to rotate from the high multiple names that don't produce earnings right now and they're valued based on future earnings. For example, Palantir, and rotate to names that produce earnings right now. The likes of industrials, financials, metals, and certain names in the technology sector. For example, old school tech, Oracle, Adobe, IBM, Cisco. These names, yes, they got hammered today, but they've been outperforming the rest of the technology sector year to date because they produce present earnings. That's very important. But here it is, Palantir, number 3, with a little over 366,000 contracts. About 66% of those were calls. What about the unusual activities taking place in the options market today? Let's start with the ticker EWJ for the Japanese ETF. They are making a bearish bet by buying the June 18th 62 puts with expectations that the EWJ will drop over 5% by then. They paid about 70 cents a piece to enter this trade, all in all bringing the total to about $1.7 million. What about the trade for the ticker ALL for Allstate? Or shall we say, Allstate, are you in good hands? They're buying the 140 calls, expiration date June 18th, with expectations that the name will rise over 5% by then. They paid about $1.30 a piece to enter this trade, all in all bringing the total to about $1 million. What about the trade for the ticker TSM, Taiwan? This is a bullet stock. However, it is being crushed because semiconductor names, unfortunately, trade in a basket of ETFs. When they decide to dump all of these ETFs, names like Taiwan and even decently valued names like Qualcomm and Texas, for example, they get hammered too. Because when you dump the ETF, you're going to dump everything in it. Therefore, I am avoiding buying the dip in these names. But here we have a trader buying the dip in TSM by buying the 117 calls, expiration date May 28th, with expectations that Taiwan will rise over 8% by then, and they paid about 75 cents a piece to enter this trade. All in all, the total entry cost $450,000. $600,000. What about the trade for the ticker XLB? They're making a bearish bet here. This is the biotech ETF. And the biotech ETF trades with the technology sector, meaning that when yields rise higher, the biotech ETF gets hammered. So they're betting for more pain to come here for the XLB by buying the 80 puts, expiration date June 18th. With expectations that the name will decline over 6.5% by then, they paid about $1.11 a piece to enter this trade. All in all, bringing the total to about $500,000. What about the trade for the ticker CRIS? This is for Curis, and the name was up significantly higher today. Last time I checked, over 60%. And by the way, you might have caught it yesterday, but yesterday we saw somebody buying the 10 calls aggressively for CRIS, and the name pops higher by the tune of 60% today. Now we have the inverse trade betting for the downside, that we will see a reversal for this name by buying the $15 puts, expiration date June 18th, with expectations that the name will drop over 8% by then. They paid about $2.90 a piece to enter this trade, all in all bringing the total to about $1.4 million. What about the trade for the ticker BMBL, Bumble? Here is yet another mania name. It is a dating app that is worth billions. Anyways, the name reported earnings after the bell, and somebody's betting for a pop after hours by buying the $50 calls, expiration date June 18th, with expectations that Bumble will rise over 7% by then. They paid about $3.40 a piece to enter this trade. All in all, bringing the total to about $1.5 million. Now, isn't Bumble a stay-at-home stock? And now that we are reopening the economy with bars and nightclubs and all of that, wouldn't people prefer to meet others in person rather than sitting at home and swiping? I don't know. Anyways, here is another ticker for you. PLBY for Playboy. Yep, we're back in the 70s again. You know, vintage optimism. But here we have somebody betting against the bunnies. How dare you? By buying the 35 puts, expiration date June 18th, with expectations that the name will drop over 13% by then. They paid about $4 a piece to enter this trade. All in all, bringing the total to about $1.6 million. Lastly, what about the trade for the ticker UNP for Union Pacific? Railroads are classic inflationary stocks. It is also happen to be a bullet stock. Therefore, if we see a serious correction in this name, down 5-10%, that will be an opportunity to buy. And here we have a trader already making the bullish bet by buying the 235 calls, expiration date June 18th, with expectations that the name will rise over 6% by then. They paid about $1.80 a piece to enter this trade. All in all, bringing the total to about $600,000. And before we move on, we are also seeing heavy bets against the chip stocks. Here it is from Bloomberg. Option traders pile into leveraged bets against chip stocks. The bearishness was evident in the SOXS. This is the equivalent of the SQQs for the Nasdaq, meaning when you buy this name, you're betting against the chip sector. And we saw the call options volume for the SOXS exploding higher to a record of 164,000 contracts. Moving on to the heat map analysis. And let's see what's going on here. We have a red tsunami across the board with very few exceptions. You take a look at the action in the tech sector, for example, pretty much every single name registered declines today. The exception is Intuit. It's tax season. You got to get something higher, but the pain was across the board, not just in the tech sector and the mania names. You have the reopening names, the stay-at-home names, the inflationary stocks, financials, industrials, materials, defensives, all getting whacked today. The energy sector was the only outperformer. Yesterday, we saw materials being the only outperformer in the inflationary trade. Today, it is energy, but also closing well below the highs of the day. So we saw a reversal in the gains for energy by the end of the day. The only safe haven in today's action, besides Intuit, of course, and the SQQs and the UVXY, if you had any of those. But the only safe haven in the stock market today was the healthcare sector, specifically pharmaceuticals. The likes of Merck, Pfizer, Bristol Myers, all of these names are decently valued. But the real reason behind their outperformance today is the fact that this side of the market, the pharmaceuticals, is an unloved sector. There wasn't a significant accumulation to begin with in these names to be dumped. On the other hand, Looking at the tech and the momentum trade and even the inflationary trade, we had a significant period of accumulation for the tech and momentum since early last year, the March bottom. And for the inflationary trade, the accumulation started all the way back since the November election, meaning that if you are panic selling and you want to book profits, you're going to book those profits from your tech names or inflationary stocks. You're not going to pick them from the drug manufacturers because pretty much everybody is underweight this particular sector of the market. Therefore, pharmaceutical stocks acted as a safe haven today. Moving on to the charts analysis, starting with 30 minutes chart of the SPY. We talked about the importance of the support level of 412. And what I said last night is, if we crack below this level, then that will open the floodgates for the SPY. And the floodgates were indeed opened today because the SPY went all the way down to pierce below the center of gravity of 406, meaning that the action we saw today in the SPY will likely have a follow-up. Let's try to find some support zones by zooming out to the daily chart of the continuous contract of the SPY. Once again, now you understand why I have been giving this chart a thumbs down for a while now. The negative divergence in the RSI playing out and the negative crossing in the MACD also playing out. We are seeing a significant loss of momentum in the SPY. And if the sell-off continues, the next destination will be the level of 3,960. And this level will be a strong support which will produce a bounce at least for the short term. Perhaps the S&P 500 takes another whack on the head tomorrow, and then we see short covering on Friday, bouncing from 3,960. What about the Qs? 30 minutes chart. And here we have the answer. Was it a dead cat bounce or was it not? Now you know the answer. While the technicals are showing that the bounce in the Qs should last for at least a few more days, perhaps going all the way to the level of 330.5 and then reversing again from that level. Yet we also mentioned the importance of combining the fundamental analysis with the technical analysis. And in the fundamental analysis, we had the CPI report. And I said if we get a hot number from the CPI despite the cooking, the Qs will continue to roll down the stairway of hell. And by the way, where does the stairway of hell leads us in the Nasdaq? If we see a continuation of the bearish activities that we saw today, that will lead us to, you guessed it, the level of 313. And remember, who's going to be waiting for the Qs at 313? Zooming out to the daily picture of the continuous contract of the Nasdaq, what's going on here? We're seeing the flush down continues, playing off the double top formation, the negative divergence in the RSI, and the negative crossing in the MACD indicator. All of these technical signals told us in advance that we will see a massive big flush down in the Nasdaq. Now that we have pierced below the support level of 13,300, we have to look down all the way to 12,766 for support. And that level should be good enough to bounce the Qs at least intraday, because once you reach that level of 12,766, the RSI reading will read an oversold reading, leading to a bounce for the Qs. What about the IWM 30 minutes chart, small caps? We had the bear flag formation and the level of support was 218. The Russell tried over and over again to reclimb 218. That did not happen, and right away you saw the flush down. Now we have some support at 208, but all of these are minor supports because the likelihood is we will see a big flush down in the IWM. And to illustrate this for you, we're zooming out to the daily chart of the RUT, the Russell 2000. We've been talking about the consolidation around the level of 2,264. The energy will be released one way or the other, and it is starting to become evident that the next move will favor the bears. We will see a flush down in the RUT, the Russell 2000. And when you look at the chart, beside the level of 2,100, there isn't any significant support level, meaning that we could also see the floodgate scenario in the Russell 2000. Moving on to the Dixie, what's going on with the dollar index? Lots of confusion here because there is this assumption that when inflation rises higher, the dollar trends lower. That might be true, but in the short run, in days when you see panic selling, liquidation of assets, that helps the US dollar. The terminology is to raise cash. Raising cash meaning buying dollars, pushing the Dixie higher. We're bouncing off the level of support of 90. We bounced from that level yesterday and the day before. The level was retested twice. That should have been evident enough that the Dixie will bounce higher, and the destination is 92. We have an imminent crossing in the MACD indicator. The first attempt was not successful, but perhaps this one will. We will see momentum carrying the US dollar higher all the way to the level of 92. What happens when the US dollar rises higher? Gold suffers. Gold has two enemies, the US dollar and yields. Both of these, the dollar and yields, were trading higher today, so gold taking a double whammy. Once again, there is this gold myth that gold is a hedge against inflation. That might be the case at some point, but for now, the correlation between gold and yields is inverse. Therefore, you're seeing in a day where inflation fears are rising higher, gold is actually trending down. So we have this myth that gold is an inflation hedge. It was back in the 70s, but this time around, it might not be an inflation hedge. What about the BTC, aka the digital gold? Bitcoin. I actually prefer the digital tulip because that's what it is. And the tulip was supposed to be the new inflation hedge. Well, guess what? In a day like today, even Bitcoin, matter of fact, the majority of the crypto market was actually trading down. So where is the inflation hedge, bro? I was waiting for it. The likelihood is that the bear flag will play out. We still have the negative divergence in the RSI. We are about to make a negative crossing in the MACD indicator, signaling a strengthening of the downside momentum in BTC, and this could take us all the way down to the level of 42,000. What about the other tulip, Dogecoin? What's going on here? We talked about Doge, the double bottom formation. Matter of fact, it is a triple bottom now, but breaking this support will actually play out the bear flag consolidation. So the 45 cents level is an extremely critical level for Doge. Breaking that will also open the floodgates for Doge. Moving on to the chart of the day, the 10-year Treasury yield. We talked about the positive bullish breakout out of the descending line. We also had the resistance level of 1.62 basis point. Well, today we have the breakout breaking the resistance level of 1.62, and now yields are going to the moon, bro. The first challenge will be 1.7. If yields manage to close above that level, then the level of 2% will act like a magnet, pulling the chart all the way to 2%. We know that if we reach a reading of 2% in yields, that will translate in a lot of pain in the equities market. What about bond prices, the TLT? Again, we are seeing the bearish technical indicators playing out, the negative crossing in the MACD indicator, and the negative divergence in the RSI. And now we are starting to break the Fibonacci retracement levels. The key for the TLT is not to break the support of 134.5, because doing so and closing below that level from the weekly candle will also open the floodgates this time around for the TLT. What about the VIX? Here we go. You know, Tom Lee predicted a rip-your-face rally because the VIX is trading below 20. Well, the only face getting ripped right now is of Tom Lee's, because this guy right here in this channel told you that the VIX will pop again, even if it is trading below 20. Matter of fact, all of what the VIX did is pull back, push that spring, and then release it higher. And here comes the rocket ship. And I gave the bull flag symbol that the VIX will break out, and it finally did that today. Massive update for the VIX, up over 20%, not just confirming the breakout over 20, but also reclaiming the support level of 25, and the next destination is the resistance level of 30.5. But you gotta pay attention here to the RSI and MACD indicators. Both of these indicators are signaling a significant increase in momentum for the VIX, meaning that the SPY will suffer more pain in the foreseeable future. Moving on to Apple, what's going on here? We talked about Apple reversing higher yesterday and reclaiming 125 for support. Yet we also talked about the gap. And if the chart reverses before closing the gap, this has always been an ominous signal. And here we are, the floodgates opened for Apple. Where is the next support, by the way? The center of gravity shifts from 131 back to 120. This is the original center of gravity, and the likelihood is that Apple will go down to 120 before catching support. Remember, the Nasdaq will reach oversold conditions, and the Nasdaq is led by Apple. If Apple goes down all the way to 120, that should be a decent level to bounce from, forming an oversold bounce. Will it be a dead cat bounce? That remains to be seen. We'll take it one day at a time. What about Tesla, the souffle? You know, once you break the line in the sand, 679, you open the floodgates. And now we have the negative divergence in the RSI and the negative crossing in the MACD indicator signaling a strengthening of the negative momentum, meaning that we will see more declines for Tesla. We're getting very close to reach oversold conditions. That will probably happen at the level of 500, but there are more declines for Tesla to come. And by the way, how bad will it get for Tesla? Let's use the weekly chart, the long-term chart, and apply the Fibonacci retracement levels. We have a giant bear flag formation. If that plays out, then Tesla will go down all the way to 500. That will be the first level of support, perhaps catching an oversold bounce at that level. But if the pain continues, Tesla could go down all the way back to 400, and that will be more than 50% declines from the highs. So buckle up your seatbelts and heat up the oven because the soufflés are going down. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the initial jobless claims, per usual, and then we have the producer price index, in addition to some Fed propagandists speaking. But the two main important numbers are the jobless claims. If that is improving rapidly, that will illustrate more inflation and perhaps a proof that the last jobs report we got was indeed cooked pretty good. The most important number tomorrow is the producer price index. We are looking for a confirmation for the CPI number we got today. If we get a hot number in the producer price index, then that is a confirmation, yet another one, that the CPI will rise higher in the next few months. What does that mean? More pain for the stock market, but specifically the Nasdaq and the high multiple names. And yields, by the way, could explode all the way to 1.8% by tomorrow if this number comes out really hot. Lastly, I will leave you with this chart. The money supply, the cocaine operation of buying assets all over the place. The Fed ushered the tsunami of liquidity last year, and that in turn also pushed the S&P 500 forward PE ratios higher, and the market rose higher in correlation, in direct excellent correlation with the money supply and the Fed's balance sheet. Meaning, looking at this chart, if we are indeed heading into tapering, regardless of the Fed's denials, not thinking about bullshit. You start thinking right now, bitch, because the CPI number came way hotter despite the cooking, meaning that the trajectory for inflation will continue to rise higher and higher and higher, and the Fed will have to taper assets purchasing. And if that goes down, the assumption is the stock market will crash down with it.
Inflation is just like alcoholism. In both cases, when you start drinking or when you start printing too much money, the good effects come first. The bad effects only come later. That's why, in both cases, there's a strong temptation to overdo it, to drink too much and to print too much money. When it comes to the cure, it's the other way around. When you stop drinking or when you stop printing money, the bad effects come first and the good effects only come later. That's why it's so hard to persist with the cure.